straight into today's financial explainer. We are taking a really deep dive right now into some massive overnight macro reversals, and more importantly, mapping out exactly what they mean for the technical battlegrounds you're going to be trading today. We've got a lot of ground to cover. We're talking widening global growth divergence, highly complex geopolitics, and hard, actionable technical levels across major currencies, Asian FX, and Indian equities. So, if you're looking for that top-down, macro to micro briefing that actually translates headlines into chart levels, you are in the exact right place. Let's get to work. Okay, let's dive into this agenda. We're kicking off with macro and geopolitics, then moving right into how markets are aggressively buying the rumor right now. After that, we pivot straight to the charts, major currencies, Asian FX focusing on the yen and the rupee, and then a quick breakdown of Indian equities. We'll wrap it all up with the major catalysts for the week ahead.
All right, Section 1, Macro and Geopolitics. We're looking at messy reality versus wild market optimism.
So right now, we're seeing this fascinating, honestly, massive divergence between a very messy reality on the global stage and just skyrocketing optimism priced into the markets. The data is highlighting a stark, widening gap among advanced economies. Basically, the U.S. economy is carrying the team. Even with higher inflation and elevated interest rates, underlying U.S. demand is holding up surprisingly well. On the flip side, you've got Canada officially slipping into a technical recession, and major parts of Europe are seriously struggling with weak growth momentum. But listen, there's a catch here. Beneath that headline strength in the U.S., cracks are definitely forming. Consumer sentiment is softening, and labor income growth is feeling the pressure. It's a classic setup. Wall Street is throwing a party, while Main Street is frantically checking to see if the bill has arrived yet.
And when you turn to geopolitics, the setup is incredibly complex. Overnight reports are telling us that a draft agreement between Washington and Tehran is largely complete. We're talking a ceasefire extension, reopening the Strait of Hormuz, and limited sanctions relief. The remaining hurdles are purely political, mostly disagreements over frozen Iranian funds. But at the exact same time, Israel has crossed the Litani River, which is its deepest ground push into Lebanon since the year 2000. So, while you've got this framework for a deal sitting on paper, the actual situation on the ground remains deeply fluid, very volatile, and frankly, unresolved.
Moving right along to Section 2, markets buy the rumor as risk-on assets absolutely surge. Spoiler alert on this one, investors are choosing pure optimism. Now, what's really interesting here is that 16.1% year-to-date gain for the Nasdaq. I mean, despite missiles literally still flying and negotiations being totally up in the air, risk assets just rallied massively. Over in Japan, the Nikkei surged 31.8% year-to-date. The markets have effectively decided that the mere possibility of an open Strait of Hormuz and the lower energy costs that come with it matters way more than the daily geopolitical drama. Investors are enthusiastically buying the rumor and leaving all the worrying for a later date. And when you look at the absolute asset price moves, the story gets even clearer. Brent crude took a massive 15% dive in May. That is the market aggressively pricing out the geopolitical risk premium, even though sure, oil is still somewhat elevated compared to January. Meanwhile, the dollar index, the DXY, stayed pretty steady, up about 1%, while the S&P 500 marched up 10.7%. Interestingly enough, Bitcoin was a rare underperformer in this mix, actually extending its year-to-date losses. So I guess not every single asset class got the bullish memo. All right, Section 3, Major Currencies. Let's get into the technical outlook.
Before we dig into the specific levels, we need to know the catalysts driving today's price action. We just had softer-than-expected US PCE prints. Headline and core PCE rose 0.4% and 0.2% month-over-month, respectively. Now, the annual readings are still running hot at 3.8% and 3.3%, but the slight softening is notable. Over in Europe, the Big Four flash CPI prints have essentially cemented an ECB rate hike for June 11th, with money markets now pricing in just under 65 basis points of tightening for the rest of the year. For today, keep your eyes glued to Fed Chair Powell's speech and watch those European manufacturing PMIs and UK HPI numbers closely.
Okay, let's rapid fire through the technical terminals, starting with the DXY. Easing 10-year Treasury yields have brought it down near the 99 level. The structure right now is a low-conviction buy on dips. You want to watch resistance at 99 flat and 99.64, with support sitting down at 98.60. Now for EURUSD. Despite that ECB hike narrative we just talked about, the technical theme is actually a sell on rise. It really has very little momentum support right now. Resistance sits at 1.1679 and 1.1730, with support at 1.1656 and 1.1612. Finally, the GBPUSD. This is also a sell on rise, but listen, you need tight stops here. It did catch a slight bid recently on some cautious optimism and local UK election results. Resistance is heavy at 1.3472 and the key pivot of 1.3558. Support is below at 1.3393.
Moving to Section 4, Asian FX. We're zooming in on the Japanese yen and the Indian rupee.
Over in the Asian currency markets, we're seeing central bank interventions aggressively clashing with raw fundamentals. The situation in Japan is just stunning. The Bank of Japan has spent nearly $75 billion on currency intervention over the last 4 weeks, and honestly, they have almost nothing to show for it on the charts. But fundamentally speaking, their government stimulus does seem to be working. Industrial production unexpectedly rebounded by 0.8% in April, and retail sales actually grew 2.1% year-over-year. Plus, the Japanese 10-year bond yield has eased back to 2.65% as those geopolitical tensions cool off a bit.
So how exactly are we trading the USDJPY? Tactically, the view remains a buy on dips. However, and this is crucial, because those massive intervention risks are still hanging over the market, you absolutely must use strict stops. You'll hit heavy resistance up at 159.77. On the downside, the critical support levels you need to watch are 158.93 and that crucial 158.68 line. Keep those marked.
And this brilliantly illustrates what happens when central bank action actually aligns perfectly with the macro tailwinds. Over in India, the rupee just surged to the 95 per dollar level. That's its strongest one-day gain in nearly 2 months, ending up 0.7%. This massive move happened because the Reserve Bank of India was selling dollars at the exact same time that oil prices took that sharp 15% drop we covered earlier. Now keep in mind, India's forex reserves did take a $7.5 billion hit from these interventions. Also, the provisional GDP print just got postponed to June 5th, and trust me, the market is going to be watching that release like a hawk.
Looking at the daily timeframe for USDINR, the setup is a sell on rise. But here is the absolutely critical level to write down. For a truly high-conviction sell, that weekly pivot at 94.77 needs to break. You've got to keep your eyes glued to that level. Above current price, you have resistance at 95.21 and 95.43. Support sits at 94.92, followed by that pivotal 94.77 mark. If price action breaks below that pivot, your next downside target is 94.51.
Section 5, Indian equities, breaking down the nifty technicals.
So the crucial point to understand here is that while the rest of the world was in this wild risk-on frenzy, Indian markets took a pretty sharp breather to end the week. The Nifty 50 shed 1.5%, the Sensex lost 1.4%, and we saw broad sell-offs across mid and small caps. Why? Well, 3 distinct triggers converged in the final trading hour to create a perfect storm. First, the MSCI May 2026 rebalancing took effect right at the close, which triggered some really heavy passive outflows. Second, the IMD downgraded its monsoon forecast to below normal, which rattled sentiment. And third, the India VIX suddenly surged roughly 9% to hit 1635. That was the sharpest single-day spike we've seen in weeks.
Taking all that chaos into account, here's the tactical setup for the Nifty. The index closed out at 23,547. Despite that late session pullback, the broader technical structure dictates that it remains a buy on dips. However, you need to pay very close attention to overhead supply right now. The key resistance zone is sitting right between 23,771 and 23,820. Why there? Because it aligns perfectly with the 21 and 50 weekly moving averages, converging right at that spot. On the downside, if it falls below 23,576, your next major support doesn't kick in until 23,439.
Finally, Section 6, the week ahead and the upcoming macro catalysts.
Let's move ahead and see how this builds, because we are staring down a massive data dump this week. In the US, it's a heavy hitter week. Non-farm payrolls, JOLTS, ISM surveys, and jobless claims. Remember, US inflation is stubbornly sitting above target, so every single one of these data points is going to swing rate expectations. Over in Europe, we're getting crucial inflation and GDP figures. And across Asia, looking at India, China, Japan, and Australia, we're getting key growth and PMI data. Simply put, this week is going to deeply test all of those central bank divergence narratives we've been talking about.
Which leaves us with this final pivotal question as we ring the bell on today's explainer. Will June confirm that U.S. exceptionalism actually remains intact? Think about it. With global growth splintering, central banks openly intervening in markets, and geopolitics completely hanging in the balance, the market has still chosen blind optimism. But this week's data dump, that is going to be the ultimate lie detector test for that resilience. Keep your stops tight, watch those pivot levels like a hawk, and stay focused. We'll see you on the next explainer.